What is up, everybody? This is going to be a new series where I put together almost like a free trading course. It's going to be a bunch of modules, and I'm going to go over things that you guys see on my charts like gap jumps, profile plays, expected value. I'm going to talk about top ticks, bottom ticks. In this video, we're actually going to be going over ranges, which is really a major component to my trading. So this is going to be a playlist for you guys to look forward to, where I put together a bunch of modules on what's going on in my charting and my trading. The reason I am doing this is because I sell my prep session at this coffee, link in the description, or you can scan the QR. You're going to have to create a coffee profile, and then you can go to the membership section, and you will have access to exclusive Fat Cat videos, hours and hours upon hours. Tens of hours of material is what you're going to be buying per month, by the way. And in these prep sessions, I go over excruciating detail about what I'm looking for, why I'm drawing what I draw on my charts. I'm showing you, where I draw profiles, where I draw gaps, where I'm calculating expected value moves, where I think high probability plays will be. The thing is, it's a lot. And this is why I'm putting together this new series. So those of you who are thinking about buying it, this should help clear up a bunch of things. So that way, when you do decide to go the prep route, you will have a better understanding of what's going on. And those of you who've already bought the prep, thank you so much. You're the reason why I'm doing these videos, and your membership fees are why I'm making these videos. Yes, it's going to YouTube for free. However, it is an incentive for me to make more videos for YouTube. So those of you who are already doing this, you're helping the community out through these videos, just so you know. All right, guys, so what we're going to do in this video is we're going to talk about ranges. This topic is going to be about ranges. So as you can see, every market puts in ranges. Every market ranges, every market range. This is the ES E-mini, by the way, and this is a daily chart. Notice that for the better part of a year, we were in a range. I mean, there's ranges all over the place. There's a range up here. Hell, there's a range in here as well. There's a range over here. Right here, it's kind of channeling up. Not quite a range, but hell, there's even a smaller range right in this section as well. And then ranges are fractal. They're going to be on every time frame. So this is a daily chart. This is going to be a 240-minute chart. As you can see, there's a bigger range here. But there's a smaller range inside of this bigger range as well. And we can go all the way down to a 10-minute chart. You can see there's a range that was in this section. It started to come out right there. This is mostly in a down channel right here. As you can see, there was some ranging up here as well on the 10-minute. Not the cleanest ranges, but there's one right up there. So the point of what I'm trying to make here is, here's a 30-second, by the way. Now, on these really small time frames, you're going to get a lot more ranges. So here's where the market's been currently trading today, since lunchtime, roughly. There's been a range in that section. Pre-market, it looked like there's a range down here in this section. You can see right there. We'll delete this. So this is a 30-second, so there's a range right here. So ranges are fractal, and ranges actually have a high statistical rating. So I've talked in the past about tagging trades, and one of the tags that I've ran for a very long time is a tag called mean reversions. Let me pull up an old video here called Art of the Trade. I would definitely go watch that. So in this video, I pause it, so it's like me over me. Notice right up here, at the time, techniques for high probability entry. One of those techniques I talked about was called a mean revert. It has a 4-to-1 win to loss ratio. So there's edge in mean reversions. Mean reversions is one of the higher statistical probabilities with edge for me. Going back to a 30-second ES chart, as you can see, we have a range in this section. So a mean revert, you may hear this in other trading communities, a mean reversion is simply trading the edge of a range or fading back into a range or a mean. So anytime you guys hear me talk about a mean reversion trade or going back to the mean, I am fading a range or fading back into a volume profile that has a good bell curve shape to it. Now, volume profiles and bell curves will be another module in this playlist. However, when I say mean reversion, it's applying to price action on a chart like these ranges or a bell curve. So that way, when you guys go watch other videos, like one of these 3 videos here, where I narrate trades on the hard right edge, I suggest you guys go check those out. When you guys hear me talk about a mean revert, now you know what I'm talking about. So what I want to do is talk about mean reversions and the statistical components of that. So when I've measured the statistics on means, I had 2 tags, and these are tag ideas you can use for your own trading. So I had 2 tags. I actually have 3 tags, so we'll talk about them. These are tags. So when I talk about tagging trades, and for those of you that aren't aware, it's always a good idea to tag your trades. And these are tag ideas you can use. So I originally started off with 2 tags, the mean favor and the mean against tags. Now I have a mean mid tag, which I'll talk about here in a moment. So what a mean favor tag is are you trading the edge of a range or the edge of a bell curve? For this video example, we're going to use just a price action range. Are you trading back into the middle of a range? And what you can do is use this mean favor tag, and that's what I did. Or are you trading against the mean? Are you trying to break out of the top edge or the bottom edge of the mean? So are you trying to hit a breakout like this? Are you trying to short it here? So if you're trying to trade anywhere, and I'm going to draw a box around the range. Actually, let's use this range over here because it is a bit cleaner. So once I know that there's probably an established range, and I'm going to zoom in on this. So the top of the range would be the top of the yellow box. The bottom of the range would be the bottom of the yellow box. Now I do use these yellow boxes for a setup called a gap. I'm only using the yellow box for an example here, so this isn't what that means. When you watch my recordings, don't think that these yellow boxes are a setup in this example. I'm simply using this to demonstrate how to use these tags. So if I'm trying to go against the mean, anywhere within this range, within the range, so right, there's a several tick range in here. How many ticks is in here? And this is very rough. There's about 9 ticks in this bottom yellow box. There's probably about a 9 tick area up there. So if I'm trying to go long in this yellow box, that would be the mean favor tag. If I'm trying to go short in anywhere in this yellow region, that would be the mean against tag. Okay? And up here would just be the opposite. If I'm trying to go short somewhere in this yellow region, it would be the mean favor tag. If I'm trying to go long, it would be the mean against. I'm trying to trade against the mean. I'm trying to hit a breakout trade. So basically a breakout trade of a range would be mean against, and trying to go back into the range would be mean favor. Now, for me, statistically speaking, there is a massive edge in trying to trade back into a mean. Now, I do have another tag, which I will briefly talk about, called mean mid. So what does mean mid mean? It means I'm attempting to take any trade near the center of the range or the center of a mean, whether that's a profile or a range on price action. Again, we're going to talk about profiles in another module. So that is what that tag is. You can use that tag if you would like, or you could use the other two. So again, statistically speaking, there is a massive edge in me fading back into a range. And statistically speaking, trying to play breakouts does not work. There is no expected value there for me. That is a losing trade for me. And most of the time, I'm going to lose money on trying to break out. So playing breakouts is not advantageous for me. Now, the thing is, the market is mostly mean reverting, okay? The market is mostly in these micro ranges. Again, you're looking at a 30-second chart. So most of the time, the market is going up and down. Hell, we could even go lower to a 3-second or a 1-second chart, and you're going to see these even more micro ranges. So for me, there is edge in attempting to mean revert. So what I'm doing is I'm always fading a range. Now, I do take breakouts. That is under very specific certain circumstances where I know there's a high probability it could work out. But for the most part, I'm always fading a range. Let's take a look at this 10-minute. So let's look for actually, let's go to this 120. This would be a better example. So remember I said there's a bigger range right here. Notice there's a bigger range up in this section. Here's the deal. Since this is a very large time frame, there's actually a micro range down here. And this kind of goes into higher time frame analysis, which that will be its own module. So let's do a quick example of what it is I'm talking about. So again, on this 240-minute chart, there is a larger, higher time frame range going on right now. However, if you notice there, it is comprised of these more micro ranges you can see down here. So, for instance, and this is how you can better understand how you should manage your trade and how you should let a trade breathe versus being tight on cutting it for break evens. There is a micro range down in this section. So if I have a trade idea where I think it's going to come down here and I'm like, hey, we're in a larger time frame range. So on the higher time frame, I think we should go long. However, what I want to do is look at micro ranges. So what I can do is zoom in, and this is going to be on 12/21. I remember this. This is actually a multi-day composite. So we're going to zoom in right here. There is a micro range in this section. And it's really not that micro. This is actually bigger than you think. Because it spans many days, and it spans, well, hell, it spans over 500 ticks in the ES. So that's a big micro range. However, on this higher time frame, it's a smaller range. So what I could do is I'd be more likely to long it down here and put on a bigger stop and let the trade breathe. Now, what I could do is I could get long up here, but I'm breaking out of the micro range, which again, it's not really a micro range, but for the sake of this, we're going to say it is. What this would be is going long here would be mean favor. Going up here would be mean against for the hashtag. So up here, I would be more tight on management. Now, if we zoom out, really, if we zoom out, hypothetically speaking, I'm still at the bottom of the highest time frame range. So theoretically, it's still a good trade to go long in this example. Okay, and yes, I know this is hindsight analysis, but once you can see a range establishing, you can leverage these theories. And at that point, you need to, have management skills. So right here, yes, what we're looking at is we're still at the bottom of a bigger picture range. So theoretically, anywhere in one of these two yellow boxes would be, a great long if we think the market's going to continue to mean revert on the higher time frame. Same thing with what's going on up here. So what I can look at is this would be mean favor if I'm trying to short. So I would more likely be inclined to having a larger stop on or letting the trade breathe versus down here. I want to be a little tighter because I am trying to break out of this micro range or this micro mean. Yes, it could mean revert on the higher time frame, but for the sole purpose of attempting to execute a range, because again, these all markets and all products range, and they are fractal. There is a range and a range and a range. So as you go down time frames, there's going to be micro ranges within these larger ranges. So I would be more comfortable and I would be in a better position if I was trying to fade up here versus down here. Now, the way you want to look at a range is the center point of the range is like the solar system. All the planets are rotating around the sun, okay? The sun has a gravitational force. So you want to look at the center point of these ranges like it's the sun. That's going to keep pulling the trade back in. Hell, the price action is ranging for a reason. We'll get into that reason a little bit later, but the price action is mean reverting and ranging for a reason. It keeps wanting to go back to that center point. It's not finding more buyers as it gets to the higher area, and it's not finding more sellers when it gets to the lower area. And these ranges, the longer they go on, the wider they are, the more days they span, the bigger the move when they finally go. It's like a spring being wound up. As the market is chopping and ranging, the market is getting wound up, and at some point there's going to be more of an explosive run. In my opinion, it's because more and more traders are being trapped, and these are traders that are trading different time frames. Remember, traders trade different time frames at different times for different reasons and different purposes. We're commingling with higher time frame participants, algos, swing traders. There are different people doing different things for different purposes on different time frames, and the longer a range goes on, the more it's attracting participants, the more participants are getting in, the more explosive the move will be when it finally goes. And for me, I will feel safer longing the bottom and shorting the top. Otherwise, I'm going to have to be a lot tighter on management because the trade could keep coming back in because the center of a range is very gravitational. It is pulling the price action back in. So I want to leverage that price action. I want to leverage that price action and use the gravity to help push my trade out. And I can even use the center point of that range as a scale out point, only in case it's going to keep coming back in. So that way I can cash flow a bit on the trade. And think about it this way. When we were going to the moon during the Apollo program, what we would do was, and this is even for deep like spaceships that go way far to check out places like Uranus or Pluto or other places like that. What they do is they take these spaceships and they'll spin them around the Earth, and that'll get the speed going, and then they launch it out to another planet. For instance, when Apollo 13, and by the way, I was actually on Apollo 13. You can see live footage of me on Apollo 13. When I was on Apollo 13, the space craft had issues on Apollo 13, right? It didn't make it to the moon. One of the O2 tanks exploded. But instead of like spinning the spacecraft around and bringing it back to Earth, they had to go all the way to the moon. They used the gravitational force of the moon to go orbit around it and slingshot it back to Earth to get it back in. That is the same principle with these ranges. I want to be on the outer edges of the range and use a gravitational pull to help get into a trade and have it work more favorably, easier for me as I'm getting in versus trying to break out of it. And I want to use that gravitational pull, hopefully get a free peak, meaning I'm getting free ticks almost instantaneously. And obviously there's going to be a problem with it attempting to break out the other side. However, I want to work with gravity, have it work for me, versus having gravity work against me. Now, there's a lot more nuanced stuff, and that's where a full-blown course will be developed. When it comes to fading ranges, you just don't fade a range to fade a range. You really need to, there's a lot of nuanced stuff going into it. However, looking at it from this broader perspective, that's what I like to do. Now, what we can do is we can go back and look at this on a 10-minute time frame. So this is a 240-minute. Let's go look at this same range on a 10-minute. All right, guys, so we're going to be looking at this specific section. So here it is on a 10-minute. And obviously it spanned many days. Now, as we get a better look at it on a 10-minute, you can see there are even more micro ranges within it. So let's look at the bottom end of this thing. So are there any good micro ranges down here? Yeah, there kind of is. So coming in multiple days, you know, we can see there's a micro range down here. So what I could do is split up this section. Hey, I see a micro range being established. So what I could do is attempt to time this even smaller time frame range to get long. And attempt to ride it up. Hell, even right here, there's a micro range. So I would want to attempt to long it down here. You know, some areas there really isn't quite a micro range. Now, when it comes to breaking out, do we have any micro ranges on the top half? We do have some micro ranges on the top half. It's been a while, so I am scrolling through this. So this is when it finally sets up for the breakout. Now, the thing is, if I am trying to go for the breakout, let's go to the day where it did break out once and for all. It would be in this section. Now, if we go down to a 30-second, we're going to see even more micro ranges. They're not very clear on this 10-minute chart. So what we can do is keep going down smaller and smaller time frames until we get that range. There is a slight range in this section. You can see it. Hell, there's one right here as well. This would be 3 in the morning. This is going to be roughly around the open where it starts chopping a lot. So this is where the finesse is. So you do have a range in this section, right? So what I could attempt to do if I notice that's a range is attempt to long it down somewhere's down here. Now here's the deal. We are attempting, even though we're leveraging a micro range, right? We are using the micro range. You know, we're looking at it on the breakout day of, let's zoom out right here. So we're looking at this section right here. Do I know it's going to break out on this specific day? Not necessarily. I might have a good idea. However, looking at the higher time frame, I know that even though I'm fading the bottom of a micro range to go long, I know that I'm attempting to break out of a higher time frame. So I might be more tighter on my trade management. Now, in my trading, there's a million other things that are going on that will be covered throughout these other modules. that could keep me off to actually holding and managing. But for the sake of just looking at ranges, I know that I am trying to play a breakout of a higher time frame mean. Okay? So I might be a little more tighter on my management. However, on the smaller time frame, I am leveraging a micro range to attempt the breakout. So if I'm attempting to break out of a higher time frame range, let a smaller range set up, because I want to always work with gravity and never really against it. Again, there's a time and place for that. However, tracking hundreds, if not thousands of trades, so I know tracking with this mean favor tag, this has statistical edge. This has statistical edge over the other two fucking tags. These tags are not going to make me money, where this tag statistically does. So this is why if I'm trying to play a breakout, I want to leverage some sort of mean on a smaller time frame. Even if it's on a 3-second chart. If I'm like, hey, this is going to break out, I almost always want to leverage even the most micro little 6-tick range. I always want to almost be fading the bottom of that and have gravity working for me. Now, the thing is, when you're trying to break out and you're leveraging a smaller mean, you got to understand it's not going to be as good unless the higher time frames are really agreeing with you. Going back to the 240, you know, there is a bigger range here, right? Let's just say this is a smaller time frame. You're going to have more edge attempting to get it here at the bottom of a higher time frame range, at the bottom of a micro range, than you will trying to, say, do a breakout up here where you're trying to break a higher time frame range by using a micro range and getting at the bottom of the micro range at the top of a larger time frame range. So that's how I'm going to adjust my trade management. I want the odds to be really stacked in my favor. So if I'm fading the bottom of a higher time frame range, that's already an ace card. Think of it like poker. I have a great video on expected value where I talk about poker hands. And then I also have this video on A+ trades where I refer it to as poker hands, like Texas Hold'em poker. So what you want to do is when it comes to ranges, they are going to be almost like an ace card. So if I'm at the bottom of a higher time frame range, that's already an ace card. And if I'm leveraging a micro smaller range and I'm at the bottom of that, at the bottom of a higher time frame range, now I have two ace cards, right? Versus me trying to do it up here. Sure, there's a micro range up here and I can attempt to fade this one long. And yeah, that could be an ace card, but on the higher time frame, I'm going against the higher time frame means. So I don't have two ace cards. So therefore, the expected value of the trade working out overall is not as good. So therefore, my management will be adjusted. So why do you need to know about ranges? Well, we're in a different trading environment. We are in a different trading environment. This is the new normal. This new trading environment is very choppy, very rangy, all the way down to the smallest time frame. Even the higher time frames, this market gyrates like hell. Okay, guys, so let's talk about liquidity for a moment. So this is why, in my opinion, the market is more choppy than it's ever been, and this is just how it's going to be from this point forward. Could it shift? Yes. So this is the liquidity in 2018 on the ES versus now, 2023. So I started trading around 2016, the end of 2016. This is from my How to Read a DOM video. Most of you probably know what that video is at this point, my most popular video. So back in 2018, you can see that the bids were roughly around 300 to 400, even 500 on the offer, versus today. You're not seeing 300, 500, 400 bid. You're seeing about 150, even in the 40s, 70s, 60s. That is liquidity. there is less liquidity on the bid offer now than there was in 2018. So let's look at this daily chart. All of these are daily bars. This is 2018 back here. So this is 2018 roughly when I took that screenshot you see here. So here's 2018 and here's now. Now look at the volume below us. So let me actually make myself disappear. Goodbye. I said goodbye. Look at the volume down here. So this is going to be your daily overall volume. I drew this yellow bar across it. Notice that the volume in 2018 is just as much as it is now, roughly. Sure, there's more shallow pockets down here than there are up in this section, but roughly we're seeing generally the same amount of volume trade across the markets many years ago when the liquidity was thicker versus now. So again, take a good look at this. The volume is roughly just as much as it was back then than it is now. Yes, you have less pockets. See, there's slightly more pockets. But overall, the daily volume is roughly the same. So what is that telling me? So what that is telling me is larger traders, since we have roughly the same amount of volume coming in each day in 2018 as we do in 2023, since there's less liquidity, larger traders now have to break their orders up into smaller chunks. Larger traders are going to submit smaller market orders. Back then, you would see 100, 200 lots hit the bid offer all the time, and it wouldn't move the market. Now, if somebody is to sell 100, 200, 300 lots in one go in today's environment, it would drop the market many, many points really fast. Versus back in 2018, if somebody sold 100, 200, 300, it's going to only maybe drop the market a tick, if that. So the market is more prone to actually making bigger movements based off of larger orders coming in on the market order side. If you don't know anything about market orders, I have a video, market orders for limit order, or the how to read a tape video where I go more in depth about these market orders. So since larger trade, and that's if you don't understand what I'm saying. So if larger traders are more prone to moving the market, they don't want to do that. That's slippage. These larger traders are trying to get in at roughly the same price. So what they have to do now is they have to cut their orders up. They have to submit smaller market orders so that way they don't just move the market several points. And they're going to be more prone to reloading and running iceberg orders. And you're going to see a lot more refreshing, absorbing, reloading on the bid offer. Okay? If you don't know anything about absorption or reloading, I have a video talking about that. So these larger traders have to be more careful. Back then, they were able to, get in at roughly the same price a lot easier. They were able to get thousands of contracts in at roughly the same price. Again, in this environment, they can't. And because they can't and they have to cut orders up, even though the daily volume is roughly the same, since they got to cut their orders up more, you're going to get more gyrations and more chop on the overall market. So when we go back to our normal price action chart, our bars, you're going to get more chopping, more gyration in today's environment than you did in yesteryear's environment. So this is the new normal. We are now in an environment where it's going to be choppy, and it's going to be excruciatingly rangy because larger traders now have to cut up their orders into smaller quantities, whether they're reloading or submitting smaller market orders versus when they had to do it back then. So therefore, that's why, in my opinion, we're getting more gyrations, more chopping, and this is what the new environment is. Especially since the overall volume is roughly the same on a daily basis as it was in 2018 as it is now. And statistically tracking the mean favor tag, it has statistical edge. And these are my theories on why it's best to fade back into a range than trying to break out, because from my own personal experience, there's edge in that. The range on price action charts are also contextual. Ranges tell a story. When you have a range, that is fair market value. Yes, we can look at a volume profile, again, another module to determine fair market value. However, without looking at any volume profiles, looking at a chart and seeing where it's ranging, the market is currently in agreement at that point. And usually in those areas, you're going to have larger traders taking advantage of those ranges by cutting up their orders and working those ranges. Now, the thing about a range is, remember what I said earlier, the longer it goes on for, the taller it is, the more extreme that breakout eventually will be. Because at the top of a range and at the bottom of the range, you're not finding additional sellers at the bottom and you're not finding additional buyers at the top. So therefore, participants are getting trapped there. Again, the longer it goes on for, the taller it is, the better your risk to reward ultimately will be once it finally decides to break out. Risk to reward is dynamic. You just don't think, hey, I'm going to do 5-to-1 trades. That's not how it works. What is the price action telling you? And the longer a range goes on, the better it's getting. And the best attempt is attempting to get in near the bottom. And if you can't get in at the bottom, try to leverage a smaller time frame micro range at its bottom to get into it. Now, you do need to be careful with leveraging those micro ranges. So if we're at the top of a range, like right here, and let's say on a 30-second chart, there's very small ranges up here, you do need to be careful because you have the mean below you on this medium size range, and then on the highest time frame, you also have the mean down here. So you are still fighting gravity. Yes, on the smallest of time frames, you're going with gravity, but this is why it's important to have different charts of different time frames. You want to make sure you're attempting to go with gravity on almost all time frames. And this is what markets do. They range, break out, range. They range, break out, range. And for me, there's a lot more edge in trying to trade means, trying to trade ranges, than just trying to get into a breakout once it's happening. I struggle with those, depending on the context. So ranges are telling you a story. This is, and I have a video on context. If you don't understand context, context is simply telling a story. Price action, these price bars are what's telling me a story. These price bars, these ranges are like reading a book. These are like the words in a book. This is telling me all a story, okay? And now we know how to, because of what I'm sharing with you, this is how you read that story. And statistically speaking, ranges want to pull near center. Look at charts. That's what they do. You know what I mean? Like, look at this. Look how many times it fucking tested. 1, 2, 3, 4, 5, 6, 7, 8, 9 times. If I'm trying to short it down here, I'm going to get fucked up 9 times. And then it never fucking worked. Do I really want to gamble and attempt to play a breakout up here? Sure, I might think there's a breakout, but what I need to do is leverage the range and be in a safer position to where I'm working with gravity. Okay? And since this range has gone on for many days, there's prone to be a very large blowout. Look how this range went on for many, many, many days. It went on for like 1, 2, 3, 4, 5, 6, 7, 8, 9, something days like that. I don't know. This went on for about 2 weeks, last I recall. It went on for definitely, a week and a half, 2 weeks. And yes, it did pull back, but look at how massive that push out was. And then you have a range up here that went on for, you know, over a week's, you know, many, many days. And then once it finally blew out, look how far it went down. Even here, we have a range. Now, let's adjust this. It's not the best looking range, and the higher the time frame, the sloppier the range. The smaller the time frame, the better looking the range. Okay, keep that in mind. So yes, there's a range roughly down here, and this goes on for many, many days. And then once it finally goes, look at how big the run is versus looking at a 30-second chart. Look at this 30-second chart. See, this went on for several hours. Decent blowout once it finally went on. However, let's look at this really minuscule micro range right here. Look at this really small micro range. What did this go on for? It went on from 1038 to 1048. This is only a 10-minute range. Sure, it blew out, but the blowout wasn't that big. It was only, you know, 7 ticks, and then it fucking came back in. So this is me showing you the bigger the range, the longer it goes on, the bigger the blowout. And this can be ways to time swing trades as well as getting into a great intraday trade. So I hope you guys enjoyed this. I hope you enjoyed looking at my thoughts and opinions on ranges. Ranges are one of the biggest components in my trading. It is one of the foundational things, and this is what I do to create context and to create narrative and to create the story of what the market is doing and what it could potentially do. Anyways, guys, please like this video. And remember, I do have this coffee here where you can buy tens of hours of my daily preps where I talk more about this shit and then you see the system as a whole. This specific video you just watched is simply a component into a larger trading system, which I have a video on ecosystems. Check it out where I talk about trading systems as a whole. This is just simply a component. And once I have all these videos released in this playlist, I highly suggest you come back and watch this video again so that way you can start to better grasp it. Anyways, guys, I'll see you in the next one.